Most people don't realize this. Hiring the wrong financial advisor could cost you millions. Hi, I'm Eric Rodriguez, certified financial planner and founder of Wealth Builders LLC. And in today's video, I'm walking you through the 10 questions you need to ask any advisor before trusting them with your life savings. Everything I'm sharing today, this is straight from my book, Selfish Plug, Retire on Your Terms, 6 Steps to Build Your Wealth. There's an entire chapter on this, but what these questions have done is it's helped countless people avoid costly mistakes when they're in the process of hiring a financial professional. So if you're thinking about retirement or just want to make smarter decisions with your money, this could save your financial future and really benefit you. Now, before we dive in, here's some context that most people don't know about the financial services industry, specifically the financial advice industry. Well, first off, there are about 370,000 financial advisors and over 900,000 insurance agents in the United States. And why did I mention insurance agents? Well, because a lot of insurance agents pose as financial planners, but they're not real financial planners. And I'll explain that here in a few minutes. But out of all those numbers, 2% are fee-only fiduciaries, the kind who are only paid by clients and legally required to put your interests first. So not all advisors are created equal. And that's where the Certified Financial Planner certification, the CFP certification, comes in. Becoming a certified financial planner is a lot like becoming a Navy SEAL, metaphorically speaking. I use that analogy because anybody could call themselves a financial advisor, but a CFP professional has to earn it through many different pillars. Just like Navy SEALs have to go through BUDS and extensive training, they're held to a certain standard. CFPs are as well. So the first component is education. They have to complete a CFP board registered coursework and hold at minimum bachelor's degree. Then there's the examination. They have to pass a brutal 7-hour, 170 question exam covering every area of financial planning. Then there is experience. You have to have 6 hours of planning experience or 4,000 hours under an apprenticeship model. Then there's the ethics component. So you have to commit to a strict code of ethics and fiduciary duty. And here's something personal I'm proud of. Only 2.7% of CFP professionals in America are Hispanic or Latino, and I'm honored to be a part of that group. Now let's get into the questions. We know there are hundreds of thousands of people in the US calling themselves financial advisors, but again, not all of them are looking out for you. Some are trained to build a plan and guide your future. Others are trained, quite frankly, just to sell you stuff. And the problem is the financial services industry is intentionally confusing. And unless you ask the right questions, you could be making one of the most expensive mistakes of your life. So let's fix that. Here are 10 essential questions that reveal whether you're talking to a trusted fiduciary or just another product pusher. And full transparency, I've worked for companies that are all about pushing product. I remember being on a conference call at one point and the sales leader at that time was promoting one annuity product and one mutual fund, saying, we have to sell this. And if you don't sell this product, you're fired. If you want to make the big commissions, if you want to make the company trip, you have to sell these 2 products or else we're going to kick you out of the office. True story, scary things. First question you want to ask somebody when you're interviewing them to manage your wealth is, what's more important to you? Investment management, financial planning, or both? Here's the right answer. The right answer is both. I'd give a higher preference for financial planning to help you reach your goals. Here's the wrong answer. If someone says investment management, that's a big red flag. That leads with products. You may not need any products. You might just need some financial advice or an actual plan. The next question, what standard of care do you provide? Fiduciary standard of care or suitability standard of care? The right answer is fiduciary. It's the highest standard of care possible in the financial services industry. Putting your interests before ours is our duty. So fiduciary is a fancy word for an advisor who is legally bound to put client interests before his or her own. Strange as it may seem, many advisors are not legally bound to operate under the fiduciary standard. Such advisors have the licenses that only require them to follow the suitability standard. In other words, some of the recommendations they make may not be in your best interest. So I recommend using a CFP professional like myself who works for an independent registered investment advisor. RIA is the acronym, because these individuals and firms have a fiduciary duty to act in your best interests, and they are legally bound to invest and manage your plan accordingly. Stockbrokers and insurance agents and registered representatives, they do not have this higher fiduciary duty. Investment advisors held to the higher fiduciary standard must select or recommend the best product for your situation, whereas brokers, they only have to recommend a product that meets your suitability requirements at the time of the sale. So again, the wrong answer here is suitability, because they are obligated to only make suitable investment recommendations at that time they're meeting with you. Next is, what financial education or credentials have you acquired? Again, I believe the right answer should be Chartered Financial Analyst, CFA, either CFP or CFA, or a Series 65 license. So the CFP certification program, as I mentioned, it's rigorous for a reason, because ultimately a financial advisor's job is to advise clients on how to protect assets and how to grow assets and what to do with the savings clients have spent years accumulating. So you should responsibly demand a reciprocal effort from a financial advisor to spend years studying for and achieving the CFP certification, which, along with the experience and ethics requirements, is a major step towards ensuring he or she has the knowledge and integrity to fulfill a sacred duty to you as a client. Here's the wrong answer. None. I have no education. I only have a life insurance license, maybe a Series 6, 63, or a 7 license. Yes. Are these legal and can someone work at a big name firm with these licenses? Yes. But these are licenses to sell products. They are not licenses to help you develop a financial plan. It's not to give comprehensive financial/fiduciary advice. Now the next question. How do you get paid? You get paid commission or you get paid by fees? The right answer is, I get paid via fees only. We don't sell life insurance. We don't sell annuities. When we do trades of stocks or mutual funds or ETFs, we aren't paid commissions. We charge a fee based on the assets managed or planning services. So it's a flat fee. You as the client will be able to determine how you want to pay that fee. So it's analogous to, if you hire a lawyer, how would you pay a lawyer? Or how would you pay an accountant? You pay them from your pocket, right? You pay them that flat fee for services rendered. It's the same way when you're working with a fee-only advisor. Here's the wrong answer. I get paid commissions when I sell you products. There's too many of conflict of interest there. They might position it as, oh yeah, I do free financial planning, or I can give you free financial advice, nothing out of your pocket. You know as well as I do, nothing in America is free. There are way too many conflicts of interest there, because they could sell you mutual fund A or mutual fund B and make 7x more for mutual fund A when mutual fund B does the exact same thing. So be careful there. Now, next question. What are the potential conflicts of interest in working with you? Well, the right answer could be, in most cases, none. I'm not obligated to sell anything. I'm here to advise. One conflict of interest a fee-only advisor might have is if they're managing your assets, they might disclose, the only conflict of interest I might have is if you have $1 million with me and you want to go out and buy $1 million property of real estate. So if I'm billing you based off your assets, I'm going to lose that fee now because you're going to go buy this real estate. But if you're a flat fee advisor and you're charging them a retainer, it really doesn't matter. You can go ahead and buy that property if you want. I will still collect my fee. Now, here's the wrong answer. I only get paid if I sell you a product. Sometimes I get paid for more certain products. Basically, as I mentioned in that one example, some firms push their products. So advisors and insurance agents, they're going to sell certain products so they can get paid, for example, $20,000 on a sale versus $2,000. So that's where their conflict of interest arises, because in the fee-only structure, advisors, we get paid no matter what, and we get that flat fee, whether we sell products or we don't sell products. But advisors that sell insurance or annuities or get commissions to sell stocks, bonds, mutual funds, etc., they have a big conflict of interest because they're not eating and they're not putting food on the table. They're not paying their mortgage or rent unless they sell you an expensive financial product. Now, the next question, what is your investment philosophy? As I mentioned in previous videos, here's the right answer. My philosophy is evidence-based and academically driven. We only implement what's been academically proven to work in the markets. Here's the wrong answer. I don't have an investment philosophy. I use insurance indexing or fixed guaranteed products or active managed funds or active management. This answer is wrong because first off, 96% of active managers, hedge funds, limited partnerships, etc., they don't even keep up with the S&P 500. And these investments are super expensive. And some mutual funds can range from 2 to 5% in fees alone. So in some cases, hedge funds have a 2% management fee plus 20% of any growth. So in my opinion, this is not good for a non-wealthy person, AKA someone who has less than, a $10 million net worth. Now, the next question, do you make custom portfolios or do you use models? Well, here's the right answer. I think you use custom portfolios to align your investments to your goals and values. Here's the wrong answer. I don't use portfolios at all. I just sell insurance-based products. So, next question. How do you measure success with your clients? Here's the right answer. We measure success based on each client's individual goals. So if you reach your goals, we have a successful relationship. Here's the wrong answer. I measure success by beating the market. We all know what that red flag is. Number 9, what types of clients do you work with is the next question. Here's the right answer. I specialize in working with X. That could be a Henry, right? A high earner who's not rich yet. I work with people in tech that have stock options. I work with business owners. I work with growing families. I work with someone who's about to retire. I work with people that are progressive and have values where they want to align their money with to the things they believe in, right? That's the right answer, is you want an advisor that has a clear focus on helping somebody. Here's the wrong answer. I work with everybody. No advisor can be everything to everyone. I have some advisor friends that only work with optometrists or only work with physicians. They are well more versed and capable to help out an optometrist or help out a specific type of physician because all their clients are that demographic. So they know things that a traditional advisor probably doesn't know and some hacks that could really help you. And lastly, why have you been fired by a client? Oh, this is such a good question. Here's the right answer. We didn't align on investment philosophy or the client wanted to manage their own money. That's personal experience. Wrong answer. I sold them a product they didn't understand and all hell broke loose. So you've got the 10 questions, but here's something else to keep in mind. Other factors to consider when hiring a financial advisor. So you'll be relying on your financial advisor for financial advice that will have long-term ramifications to your life. That's why I believe it's important that you either interview multiple advisors, if you don't have an advisor yet, or you get a second opinion from one or more advisors if you already have an advisor too. So every advisor has a wide range of specialties, and every advisor has a different niche, process, philosophy, etc. So you really want to find an advisor who has the experience, the process, and the heart to address the stage of life that you are in. Some advisor traits and questions that you want to focus on is, again, do they have the experience? Do they have longevity and consistency? Are they a lifelong learner, right? Education, certifications. Is their specialty focused on the issues that you face, right? Are you just fresh out of college trying to get out of debt? Or are you someone that's close to retirement or into retirement? Two totally different scenarios. And lastly, are they consultative? Are they patient? Are they kind? You want to be intentional. You've worked too hard to trust your future to someone who isn't the right fit. So hopefully that was helpful for you. If you like this video, I'd appreciate it if you give it a thumbs up, leave a comment, share this with someone who needs this kind of information. Thanks so much for listening, and I'll see you in the next video. Once again, it's Eric Rodriguez here. If you're looking to get help securing your financial future and you're serious about implementing a wealth plan for your specific situation, feel free to check out my website, wealthbllc.com, to learn more about how I work with clients, how I help them align their resources with their values, and put together a comprehensive plan to help them retire on their terms.